Imagine waking up to find over $3 billion in cryptocurrency options contracts vanishing from the market overnight. For traders and investors worldwide, this is not a distant headline. This is the raw power and peril of the Bitcoin and Ethereum options market playing out in real time. What does this sudden churn mean for prices, sentiment, and the future of crypto itself? And why are both Wall Street giants and retail traders scrambling to position themselves before and after these seismic expiries? To understand what just happened, let's do a crash course in crypto options. Unlike simply buying Bitcoin or Ethereum, options give you the right, but not the obligation, to buy or sell these assets at a set price, known as the strike price, on or before a specific date. It's a game of strategy, hedging, and sometimes raw speculation. Options are used to protect against major swings, bet on price moves, or create income by selling contracts. When a massive batch of these contracts expires, like the one that just happened, the ripple effects can be felt across the entire market. Last week, options totaling more than $3 billion for Bitcoin and over $600 million for Ethereum reached their expiry. The max pain points, where the most traders stand to lose, were $105,000 for Bitcoin and $2,600 for Ethereum. This means, as contracts closed, prices had a magnetic pull towards those levels. Michael Vandepapa, a leading crypto analyst, observed, "The options expiry caused a brief period of volatility, but the market quickly stabilized." But what does all this activity actually do to the market? As contracts expired, open interest in Bitcoin options hit over $41 billion, with giants like Deribit and CME seeing record activity. On Ethereum, just over 241,000 contracts closed, revealing a very cautious optimism among traders. And while institutional investors made aggressive moves, boosting their long positions in Bitcoin futures by 8% post-expiry, retail traders were drawn to short-term Ethereum call options, aiming for quick profits. Yet beneath the surface, uncertainty lingers. The volatility spike after expiry was undeniable. Bitcoin's realized volatility jumped to 4.5%, a noticeable uptick. Prices whipsawed, with Bitcoin briefly touching $106,000 before dropping back. Ethereum wobbled but managed to recover. The put-call ratio for Ethereum crept up, hinting that some traders are bracing for downside. According to Greeks Live, the expiry event cleared out some of the short-term uncertainty, allowing for a clearer market direction. But not everyone is convinced the storm has passed. With more institutional money entering, the stakes, and the risks, are climbing ever higher. At the same time, macroeconomic forces, from inflation fears to political spats involving figures like Elon Musk and Donald Trump, are adding fuel to the fire. If crypto options really are the new battleground between institutional might and retail ambition, what happens when the next expiry hits, especially with volatility and sentiment on a knife's edge? Right now, all eyes are on the next wave of contracts and whether the market can withstand another jolt, or if cracks will finally begin to show. So, what does the future hold for the crypto options market after the expiry of more than $3 billion in Bitcoin and Ethereum contracts? The immediate aftermath showed us a familiar pattern, a sharp but brief surge in volatility, with Bitcoin's realized volatility climbing over 4% in the 24 hours post-expiry. Ethereum's sentiment cooled slightly, as its put-to-call ratio edged up to nearly 3/4, hinting at a cautious mood among traders. But beneath the surface, a new intrigue is unfolding. One scenario gaining attraction is the continued rise of institutional investors. After the June expiry, institutional long positions in Bitcoin futures increased by almost 10%, according to CME data. Amber Data noted that this renewed confidence could bring more liquidity and stability to the market, but it also means the stakes are getting higher. Larger players will wield more influence over price swings. As Michael Vandepapa puts it, the options expiry caused a brief period of volatility, but the market quickly stabilized. At the same time, retail traders are not backing down. On platforms like Deribit and OKX, there was a surge in short-term Ethereum call options, especially those betting on a price rebound towards $2,700. This split between institutional and retail strategies sets up a potential battleground for dominance in upcoming expiries. The question is, whose bets will pay off? Regulatory winds are also changing. Any new rules could reshape the landscape overnight, increasing compliance costs, but also potentially boosting investor confidence. And let's not ignore technology. AI-powered trading is entering the scene fast. These tools promise smarter, faster predictions, but they also bring new risks, like the threat of algorithm-driven price manipulation or flash crashes. So what does this mean for you, the viewer? Whether you're a seasoned trader or just crypto curious, there are tangible lessons here. First, don't get swept up in the hype. Every expiry is hyped as a make-or-break event, but as the data shows, markets often stabilize quickly. Focus on the underlying trends, track open interest, watch the put-to-call ratios, and be aware of where the max pain points lie. These are clues to understanding trader sentiment and possible price movements. Second, diversification and risk management have never been more important. With both whales and retail traders making bold bets, the risk of sudden swings is real. Consider using options as a way to hedge, not just speculate, and never invest more than you can afford to lose, especially in a market as fast-moving as crypto. Finally, keep an eye on macro factors. As Cointelegraph's analysts remind us, the bigger picture, like inflation or political drama, often outweighs the technical details of any single option's expiry. Use these moments as a window into market psychology, but always zoom out to see the broader trends. Sometimes the secret to success is simply patience and perspective. So, returning to the big question, who stands to gain or lose from these massive options expiries? The answer is nuanced. In the short term, savvy traders who read sentiment and time their moves can profit from volatility spikes. Long term, however, the real winners may be those who understand the market's evolution, the growing role of institutions, the integration of DeFi, and the impact of regulation and technology. And here's a secret fact. For the first time since 2019, Ethereum's value relative to Bitcoin is flashing a signal of being deeply undervalued. According to CryptoQuant data, this could mean a major shift is on the horizon, one that only the most attentive market watchers will catch. If you want to stay ahead of the next big move, make sure to analyze the data, question the headlines, and subscribe to our channel for more deep dives into crypto markets and global tech trends. Hit the like button, share your thoughts in the comments. Who do you think will dominate the next options expiry? Until next time.